Welcome, everybody. Welcome to Brunch with Bobby. Once again, I'm Jeff Finn here, and we have a special guest today, Dr. Jeff Fisher, who will be joining us to talk about restructuring and renegotiating leases as we move into this post-COVID environment, or the continuation of the COVID environment. Obviously, lots of leases and lessees are in a difficult spot, and leases need to be renegotiated and restructured. And we've done a tremendous amount of work in our MarketEdge product to enable you to more effectively analyze, compare, and help in the renegotiation process. Jeff has taken a lead with Tim in scoping out and developing the advancements to that solution. And he'll be taking us through what is in place or will be launched this week, as well as some new things that are to come. We'll have some additional, more advanced training as the product fully rolls out. But some of the things that you'll see today are just about to be launched. Some have been launched already. So lots to share, lots to learn. And we have a calendar, a slate that's just chock full of valuable information through the rest of the month, as you see on the screen. And we look forward to you joining us as the schedule continues. Of course, Bobby is on the line with us as well to help field questions. So the questions that are related to the lease restructuring and renegotiation, and Jeff will work with. And if there are other questions that you want to pose at the end of the session, Bobby can chime in as well. So feel free to ask any of your questions. We'll do our best to cover as much as we can. And with that, Jeff, I'm going to turn the screen over to you, and we'll get us going.
Okay. Show my screen. All right. And I'm just going to reverse my display settings here. All right. You should see my PowerPoint presentation.
It's there.
All right, so I'm going to go through this using screenshots today, since this is the first time that we're talking about lease analysis, and I want to make sure that we kind of cover the basics of what we're trying to do in the lease analysis part of MarketEdge. So what we're talking about is the Lease Tools, as I have circled over there to the left. In the MarketEdge, we have the investment tools, the lease tools, and the deal room. So I'm going to go into the Lease Tools area. And I want to emphasize that there's two types of analysis that you have to pick one when you're first setting up a lease to do an analysis. Actually, you can analyze a series of leases at the same time, but they'll either be from a owner perspective, owner rep analysis, or from the tenant perspective, so the tenant rep analysis. And you can see I've got the screenshot of that drop-down menu on the right. So you select either tenant rep or owner rep, and you also need to select a property type. You don't see the choices now since I have it covered up with the owner rep, tenant rep drop down, but you'll choose between office, retail, and industrial. So these are determined when you initially set up your analysis. So for the owner rep analysis, the idea here is how much does the lessor, the owner, receive? So obviously the base rent, and then there may be some recoveries, and we have a lot of different options I'll talk about for the recoveries. These would be the expense recoveries, where the owner gets reimbursed for tenants and from the tenants in some way for expenses, either some or all the expenses. You can decide which expenses are going to be reimbursed. Then there may be some tenant improvement allowance that you have to give to the lessee, so that's an offset. That's going to be a negative to the owner. There also may be some moving allowances that are given to the lessee, and there may even be some lease buyouts that are given to the lessee. So a lot of different options for what you can include that impact the cash flows associated with the lease when you're doing the owner rep analysis. For the tenant rep analysis, this is kind of the reverse. What does the tenant have to pay? So they're paying the base rent, they're paying the expense recoveries, any expenses that they have to pay directly would be included in that analysis. If there's moving costs associated with you moving to this space that you're analyzing, maybe you're moving from another space, and so part of your analysis is what's it going to cost you to move to that space versus some other spaces that you could move to. Are you going to get any moving allowances from the lessor? If so, that would be an offset to your costs. Plus any tenant improvements, TIs, that the tenant is going to have to pay directly out of their pocket. So that would be part of the cost to the lessee. But then there may be some tenant allowances received from the lessor, so that would be a benefit. And then there may be some lease buyout payments made to the lessor. So the big question is going to be who pays for the expenses. On a gross lease, the owner's going to pay. Net lease, the tenant's going to pay. Oftentimes it's somewhere in between, like especially where you have a base stop where the tenant is paying above a specified amount. I often see this being the first year expenses. So the idea is the owner has to pay the operating expenses, or at least those operating expenses that are part of that stop. Owner has to pay those the first year, but then anything above the first year you can pass through to the tenant. And as I indicate here, you can specify that for each lease. And you can also indicate how those expenses may increase over time. Somebody was asking me, why do we need to indicate for each lease how that the expenses may change over time? Well, as I said, you could have insurance that's going to go up, 2-3% per year. Maybe utilities in this low oil, price environment, are going to increase hardly at all. Property taxes may be level for a couple of years and then jump up with a reassessment. So, the different expenses that could be part of the recovery could be increasing at different rates. So, need to specify that. You can see in the lower right there, I show just the portion where you can select what kind of recovery it is. So you see the triple net, where the tenant has to pay everything. Then the stop, as I just talked about, which you could specify as a dollar amount or per square foot. You could also have a cap where once you hit that cap, then the owner has to pay again. Or there could be none, which would be like a gross lease where you don't have any recoveries. Some key measures that come out of this program would be the rent per square foot, which could be looked at on either a usable area basis or rentable area. As I'm sure most of you know, usable area is what you can actually use, whereas the rentable area would include a prorated portion of common areas, especially in office buildings. And that would be part of the space that you have to pay rent on, your prorated portion of the lobby area and so forth. But in the way we look at a lot of the ratios, even though the rent is based on the rentable area, we then look at what it's costing you per square foot of area that you can actually use. Because again, if you're a tenant looking across different buildings, I think what you care about is what it's costing you for the amount of space you can actually use when you're comparing the different leases. Then you could also look at it on a per year basis, a per month basis. Something that I'll emphasize a lot is looking at it on a present value or a net effective rent basis. So the idea here is you're going to take the present value using some discount rate that you can specify. You're going to take the present value of, if we're looking at it from an owner perspective, what are we actually going to receive as the owner, base rent and recoveries and so forth, minus any TIs. You take the present value of all those costs, and we'll show you, as I'll show you later on, we do show you what that present value is. But I think what's more important is what we call a net effective rent, which is taking that present value and spreading it back out evenly over the lease term as if it's level payments. That way you can compare leases on an apples to apples basis. It's hard to compare actual lease payments because you could have different TIs, you could have different steps, different recoveries that kick in at different time periods. And so the idea of net effective rent is it says, let's take all that stuff, whether there's abatements, there's free rent, whether there's TIs, whether there's moving allowances, whatever, we're going to capture all that in that present value, either as the benefits that the owner gets or the costs for the tenant. We can look at it both ways, and calculate what the lease payments would be if you just paid an even amount every month, every year over the lease term. So that's the net effective rent. I know some people just add up all these costs that I just mentioned and divide by the total lease term. It's another way you could do it. That kind of ignores the time value of money. It's really equivalent to doing things as if you had a zero discount rate, which you can do in the program. If you put in a zero discount rate, it'll just add up everything and divide by the lease term, if you prefer to do it that way. But I think the more appropriate way to do it is to have some discount rate, so that you're capturing the fact that lease payments that you receive, 3 or 4 years from now are not as valuable as lease payments that you receive right away. Okay, so I'm going to go through a simple owner rep example, and in more advanced webinars that we have later on, we can do some more advanced comparisons. But since this is the first time we're doing any kind of webinar related to the lease analysis, I thought it makes sense to start off with a nice simple example just to see how the program is working. So I've got a base rent of $20 per square foot in year one. That's going to increase by 2% per year. We're going to have rentable square feet of 100,000, and in this case, I made the usable square feet the same. But as I talked about before, you can have, sometimes they call it a load factor. It's the difference between the usable square feet and how much that's loaded to account for the common area that's included in what you have to pay rent on. In this case, I just kept it the same to keep it simple. I've got a lease that starts October of 2020. It's going to go for 60 months. We're going to have operating expenses. I've combined them all together, but as I'll show you in a minute, you can have details of all different types of expenses that you can label differently. But I'm just generically saying all my operating expenses are going to be $5 per square foot in year one, and they're going to increase at the same 2% per year rate. No free rent, no tenant improvements, but we are going to have recoveries. It's a base stop of 500,000, which is your year one expenses. You can see $5 a square foot, 100,000 square feet, that's $500,000. So I'm going to have that as my base stop. So just to show you what the input would look like for the base stop, or for the base rent, we've got base rent $20 per square foot per year. We could specify if there's free months, but we don't have that in this case. You can see off to the right, we have the escalation, which we're allowing you to indicate what the increase is each year of the lease term. So 2%, 2%, 2%, 2%, but of course we could, have that vary. If we're gonna, in the current environment, maybe that's gonna be zero or maybe even negative for a year, and but then hopefully we have a recovery and lease payments start escalating again. And then for our operating expense input, so off to the left, you can see there's a lot of choices. In this case, to keep it simple, I just picked a generic operating expense, but I could pick, instead of that, taxes. I could pick electric, janitorial, HVAC, and then you see 3 there that say other, but you can click on any of those and rename it. So you probably wouldn't necessarily call it other operating expenses. You'd select that one, but then click on it, and you would just change the name to whatever you want. And you can change any of these names. So these are just to get you started. Jeff, I suggested to Tim yesterday we add insurance as one of the things that are already there to choose from.
That would be a fundamental one, should be there.
Yeah,
right?
and there's probably some others we could think of. But again, this is just to get you started. I don't show everything on the drop down, but you can start to see there's improvements. That's your tenant improvements. And if I clicked on that, the inputs you would see to the right would be different, because it would be taken into consideration how much tenant improvements you have to spend on the space, and then how much of that is an allowance to go to the tenant. And then same idea with furniture and voice data improvements that you'd have to make, or other improvements. Again, you could change those names. And if we scroll down, we'd see things like moving allowances and so forth that you could also choose from. And lease buyout costs would be part of what you can select on the left. So kind of a lot of different choices there, but they all impact the cash flows. Tim and I, Jeff, were talking about whether we could separate these into some kind of groups, but you know, they're all things that impact what the tenant is going to have to pay on that lease. Okay, so we've done that. Let's see what our cash flows look like over the lease term. Again, this was a simple example just to get us started thinking about this. So you see our base rent. The 10/2020 has zeros because that's the idea there is that's the very beginning of the lease when you might have things like moving allowances. Your tenant improvements, when we add that to the example, would show up there because that's an upfront cost right at the beginning of the lease. Then everything else is what's happening over each year of the lease. And I didn't mention it earlier, but you'll notice here that it goes from 10/2020 when we said the lease was going to start to 9/2021. So it's rolling 12 months. As one of the options, when I set this up to begin with, I could have specified calendar year if I wanted to do everything on a calendar year basis, so that I'd have just a partial first year. I would just go from, you know, October through December, and then it would start off on a calendar year basis. I'm not sure I ever see anybody do that, at least in when they're doing an investment analysis. I think people usually do it on a rolling 12-month basis, more of a fiscal year, but certainly the option is there if you want to do it on a calendar year basis. Then you see the operating expenses, but keep in mind that this is recoveries. And now we're looking at it from an owner perspective here, so that's going to be added to the base rent. So remember, it was a base stop that kicked in after year one. So in year one, we have nothing there. But then in year two, that $10,000 is the amount that the expenses went up over and above that first year expense of $500,000. So hopefully that's pretty clear. And then you add those two together and you've got your net rent. If there was some TIs, again, it would show up in that very first period, 10/2020. In that case, it would be a negative because you're paying that money as an allowance to the tenant. If we wanted to add some tenant improvements, as I mentioned, you'd select improvements on the left, which again, we could rename. In this case, let's say there's $20 per square foot in tenant improvements. That's going to cost the tenant, but we're only allowing them $10 per square foot. So it's only going to cost us in an owner analysis, the $10 per square foot. The program actually allows you to finance that if you want. So we could indicate some financing information at the bottom. So again, what we're specifying here is the amount that the lessor is responsible for in that allowance box. And so now you can see that that is showing up, as I mentioned it would, in 10/2020 as a negative that the owner has to pay out to the tenant as the TI allowance. And when we talk about the effective rent, the net effective rent here in a minute, you see those tenant improvements are going to be part of that. What we're going to do is we're going to take the present value of the minus million, the plus 2 million, the plus 2,050,000, and so forth. We're going to take the present value of each of those numbers for the 5 years, but then we're going to spread that back out using the same discount rate so that we see what would it be if I just had level payments each year and I didn't have a big negative right away and, you know, then escalating positive numbers throughout the lease term. So a better way, I think, to compare leases on an apples to apples basis. This will give you an idea of some of the output that you get once you have entered in all these inputs. So we have our total rent, our present value, which I've emphasized. I'm talking about the upper left there, total rent of 9,510,000 rounded. The present value of that, which will of course be a lower number because we're discounting that. I think there was a 8% discount rate, and this will see that in one of the reports. The annual average, the average per usable square feet. Again, as I emphasized, I think we want to look at that in terms of how many square feet we can actually use. You can force the program to look at everything on a rentable square foot basis. the net annual effective rent. So that's the amount that I keep talking about that you would pay if you just had level payments every year, which would be $18.59 per square foot. You might wonder why that's lower than the average. Well, it has to do with the tenant improvements that are worked into that and taking into consideration the time value of money. Then you see your rent each year there at the bottom, the minus million, the 2 million and so forth, and the average monthly for each of those years. A graph over to the right that shows your rent each year on an annual basis and on a monthly basis. And then you see a snapshot, kind of the same information that we just talked about, but when you actually run the program, you'll see a snapshot as well as a number of reports that I'll show you in a minute. So again, the idea being you can see your total rent, your present value, your average annual, put on a usable square foot basis, and then that annual net effective rent. And I talk at the upper right there, and we'll make these slides available. One of the reasons I thought it'd be good to have slides for this first go around, something you can take and look at, download from our website. So the net effective rent, I've said this several times, but you see a summary there, calculate the present value of the actual rent, subtract any tenant improvements, and then find the level rent that has the same present value. And this will incorporate the impact of TIs, and would also incorporate the impact of moving allowances and lease buyouts and anything else that would be part of the analysis. So here I just added moving allowances and commissions so you can see how you can add a bunch of other stuff to the analysis. So we got our base rent, we got our operating expenses, we've got improvements, we've got moving allowance, we've got commissions. Oh, we better add commissions in there, right, Jeff? Did I add enough commissions in, Jeff and Bobby?
Somebody's got to get paid.
Yeah, did I add enough in, Jeff? I was afraid
I think that sounds like one of our
Okay.
guys out here would do a deal for that.
Okay, I was afraid I wouldn't put enough in there and somebody would yell at me. But I'll take right now. We'd probably be pretty happy to get $520,000 of commission. Okay, and so that gives us our net rent. You can see is a negative, when we start off with, but then positive and escalating over time. All right, so let's move on to the tenant rep. So again, what I've talked about so far is looking at it from the owner's perspective. But you may be working with a tenant and you want to show them across several different leases, what's it going to cost you as a tenant, and how can I compare each of those leases? So I kind of mirrored the examples that we had before, but of course the impact is going to end up being different, especially because of the tenant improvements, because the tenant, is going to receive those. They're not going to have to pay them. So we got the base rent of $20 per square foot, increasing 2% per year. We've got rentable square foot of 100, same usable square foot of 100. Lease starts October 2020, 60 months. Same operating expenses we talked about before, same increases. To start off with, we'll have no free rent, and initially no tenant improvements. Or no, I think we'll see what I did here. And then the recoveries are again the base stop like we had before. And then this snapshot in this case, we have now we call it operating costs, with the idea being what's the total of all the costs to the tenant, including the base rent, the recoveries that the tenant has to pay in this case. If there were any tenant improvements that the tenant was not being reimbursed for, that would show up here. In this case, even if there were tenant improvements, as we had in the earlier example, that doesn't affect the lessee because they're not having to pay that themselves. So as I noted here, when we look at the net effective rent to the lessee, that's going to be different from what we had for the lessor because of the difference in the tenant improvements. Okay. I mentioned this earlier, but when we do the initial setup, maybe I should have had this at the beginning. But you can specify things like whether you want your discounting to be the end of every month, the beginning of every month, or the end of every year. That mainly affects that present value calculation that we talked about and the effective rent. And then to the right is where I mentioned you can specify whether you want your analysis to be a rolling 12 months like we had in examples that I just showed you, or on a calendar year basis. And that use RSF only is if you want to force the program to only do all the ratios and stuff based on rentable square foot rather than the usable square foot. So after you've done all this work, what you really want to do is create some reports. This would be similar to if you've used the investment analysis, where you click on the output at the top, and then you have a lot of different report options that you can choose from. You can see a whole bunch of them checked off to the left there. And I just did screenshots of a couple of them to give you an idea that I'll show you in a minute. But when you once you've selected what report you want, you can publish them in a lot of different ways. You can preview it, preview a PDF file, which you can then save, email it to somebody, or e-publish it to create a link that would take you to the report. And that link could be embedded in emails or websites or wherever you want to put it. So just to give you an idea, and here is where this is actually in development, I should say. I think it's going to be available next week. Everything I showed you before that you could do in the program is currently live, part of the lease analysis. But these reports, Tim has been working real hard on making them look a lot nicer. It's probably a little small print to see, but you can see nice pictures across the top, thumbnails of the properties. These are just made up properties, by the way, so name change to protect the innocent and all that. So, but you can see some nice summaries of the lease information, the assumptions that we use, like it was an 8% discount rate, end of month discounted cash flow timing, and the rolling annual periods, the rentable square foot, and then the different measures we talked about, like the net present values and your effective rent. And then another report, let's see, yeah, another report. We're working on seeing if we can consolidate a lot of this into maybe a nice one pager that would be good to send to clients. And then there's a lot of graphs, both that you can see when you're entering the inputs, but also can include in the different reports. Like I like to again emphasize, if you could tell, the net effective rent calculation. So we just went through as if you were entering information for one lease, but the idea would be you're looking at a lot of different lease options, either from an owner perspective or a tenant perspective, and then you want to look at a comparison across each of those. I didn't emphasize that actually here maybe as much as I could have, that we're now looking across 4 different properties and comparing all these different numbers. And so the bottom line here might be, well, okay, if this is from a tenant perspective, which I use for this particular report, which is the one that has the lowest net effective rent? Not that that's the only thing that you care about, but it looks like the 4221 Wilshire Boulevard, in this case, is the lowest one that, all things considered, TIs, base rent, recoveries, moving allowances, whatever, that is the one that has the lowest net effective rent. So unless there's something, else you don't like about that one, the location, or whatever, that would be the winner. And then let me say something about something that's going to be coming soon, which is lease accounting analysis. May not be relevant for all of you, but there's new accounting regulations called ASC 842, which I knew nothing about till about 2 weeks ago. But this is just taking effect this year, and it requires lessees, the tenants, to put the leases on their balance sheet. Because of COVID-19, there's actually hope that there'll be some delay that in needing to implement this, because this, like I say, this was supposed to come in effect just in January of this year for the first time, and it really has a big impact on lessees. In the past, when they had an operating lease, which would be what a real estate lease would typically be, you didn't have to have that reflected on your balance sheet at all as a liability. So I know this sounds kind of crazy maybe at first when you first hear it, but the lessee now has to show the lease both as an asset and a liability on their balance sheet. They offset each other. The initial amount of the asset will in most cases be the same as the initial amount of the liability, but you can see how that would affect people's interpretation of your balance sheet. And it's going to affect different debt ratios, and it's going to affect measures that companies produce, like their return on assets. Now that return on assets, all else being equal, they're going to have a lower return on assets because one of their assets is going to be what's called the right of use space. That's actually the name of the asset that you have to put on the balance sheet, which is basically the present value of all your lease payments. So you're taking the present value of the lease payments, like we talked about in calculating the effective rent, and subtract any TIs, and that becomes something called a right of use asset. It's like your right to use space that you have when you have a lease. But then you have a lease liability on the liability side of your balance sheet that says, I'm going to have to make lease payments over the next 5-10 years, and both of those are amortized over the lease term. And I won't go into the details here, but they're amortized at slightly different rates. But they both get amortized over the lease term. And the other part of this new regulation is that the tenant has to recognize the cost of that lease on what's called a straight line basis, which is kind of like the idea of the net effective rent, where you have to have an even amount of rent that you're showing on the income statement each year rather than what the actual rent was. You can see this could really impact the way that a lot of tenants are going to look at different lease alternatives, because they now want to know how's this going to impact my balance sheet and my income statement. So we're working on incorporating this into the program, maybe 3 to 4 weeks until we can get everything in there. But we think this is going to be useful for hopefully a lot of the MarketEdge users. We'll make this optional. You don't have to do it. You don't have to see it. But if you want to, you'll be able to have this additional analysis. It uses all the same information we're already putting into the program. It's just looking at it from an accountant's perspective rather than just looking at the cash flows and the net effective rent the way we normally would. So, Jeff, did that make any sense?
All makes sense. So one of the things, Jeff, and I'm not sure how much more you have, but I think to bring this into context of today, you talked about the analysis on a property from a landlord and a tenant's perspective, but the situation and the environment is not necessarily that I'm a tenant wanting to look at 4 alternatives of different space, but it's I need to change the structure of my lease. It's sort of the blend and extend, and some of the other things that we saw in the financial crisis are coming back. And how can this analysis be used to sort of create the same net effective, but with a different structure?
Right. And I thought it'd be good for maybe a follow-up webinar. We could put together some examples. But so what I'm hearing a lot about, kind of like you said, is I want to be able to have less payments, for maybe the next couple months, maybe no payments for the next couple months. But I'm willing to have you tack that on to the end of the lease. And then one way to look at this is, okay, from the owner's perspective, I'm willing to do that, but I want to have the same net effective rent. So the program, as I emphasize a lot, we're calculating that present value and that net effective rent. And so what we could do is we could take an existing lease and then change it so that there was no rent. We could start off, rather than when the lease first starts, start off where it is today, right? And say, well, what if we don't have any rent for the next 3 months, 4 months, whatever you want to put in, but we extend the lease term, What is it going to take? How far do we have to extend it? And maybe it's going to be more than just tacking on months we didn't pay in order to get the same present value. So how much do we have to tack on at the end so that the present value is the same as we would have gotten, or the net effective rent is the same as we would have gotten? Of course, it all is going to come down to negotiation, right, Jeff? So you may not be able to
Right.
get the same net effective rent, but at least you'll know what, as a starting point, I'd like to get the same net effective rent.
And it doesn't have to be an extension. It could just be a restructuring of the payment series that, as you say, goes to zero or some lower number for the next 3 to 6 months, and then it builds up. And in the back end of even the existing 5 or 10-year lease term, there are additional payments or higher
Right.
payments than
Or
what
we could
was
just have
otherwise.
more of an
Right.
escalation,
Yeah.
or we could have less of an expense recovery here. We've got all those different inputs that we talked about to work with, right?
So you
Because
just have you would have then the four leases side by side. Here are different, like 4 different scenario planning, where you could look at 4 different alternatives that you could then take to a landlord or a tenant to say, here's how we could approach this different ways, and at the end of the day, the net present value is within, you know, a degree of tolerance that is acceptable, and or not, and that's part of that negotiation. But it gives you all of the numbers to work with and the impact on both sides.
exactly, and we'd love to hear from from our users. What kind of things are you finding you have to do or consider? Then maybe we could work up some examples. The blend and extend is what I've been hearing about the most, but I'm sure there's other things that people will dream up.
So we are open for questions if anyone has any. Again, this is a pretty significant enhancement to the MarketEdge lease analysis. Look for a first phase of the release next week, and a number of different reports, calculations, and metrics that will come out. And then the lease accounting would be in a phase 2 of that. I would say by you look at that towards the end of June, but phase 1 will be out and available for you next week. Let's see. A question is, how did you get the rolling 12-month reporting schedule? How do you get to the 12-month, the rolling
Yeah, that
12
was
month?
in the initial setup. Let's see. Here we go. On the right-hand side, you can see annual period, rolling
So the
12
global
months or
value, where does
counter.
the global value, where's that tab?
Oh, it's in the analysis. At the top, you'll be able to click on an analysis, and then global settings. I don't have a screenshot of it here, but it's just right at the very top of the program.
Yeah.
Let's see if I
There
still
we
have
go.
it
Maybe
loaded
jump.
yet. Let's see.
While you're doing that, if there are other questions, come on in. Again, it could be on other topics, but this obviously would be the main focus.
Okay, so I'm going to go into the Lease Tools, and I've just got some real simple examples set up here that I was using for testing. So if we go into the analysis, global settings, right there, let me go back and do that again. So I'm going to analysis at the top, and then I go to, and this is where I could create a new property to analyze. I could open an existing one, delete one. So I'm going to go to the global settings, and you can see in there I've got the discount rate that I talked about that's used for that effective rent calculation. And then my DCF timing is whether I want to discount end of month, beginning of month, or just end of every year. And then this is where you have the rolling 12 months or calendar. And then if you want to put in a total rentable square feet and just use that for all your ratios, you could put that there. So I can, since I have this loaded, if there's any additional questions that relate to how I got to some of the inputs, but you can see here, you've got general data, you've got your which is your rentable square feet, start dates, and some descriptive information. You've got your lease data, which is where I can select the base rent, the operating expenses, taxes. I mentioned how you can change the name. So you can see here, I could change that to property taxes. And it's not going to show up below unless I put an amount in there. So let's throw in $2 a square foot. Be sure to save that. Okay, now why didn't it show up? Because I have no recoveries. So there we go. So now we've got our property taxes. We're looking at it from an owner perspective. So if I didn't specify it was going to be recovered in some way, it's not going to show up down here. So
And you want to show the comparative analysis report where you find that, Jeff, and so that you can begin to show the different alternatives.
Yeah, and let's see, in this case, I think I've only got, well, yeah, I've got some different ones here. Okay. So if I go to the analysis, if I go to summary, here's where I have 5 different things that I had set up: a gross lease with tenant improvements, a base stop, a triple net lease, a gross lease, and then mixed recovery types.
So you'd be able to set up your 5 different scenarios, change the variables, and then you again see how they play out to get to
exactly
a solution that works for both parties.
So I was doing this to test different, ways you could have the recoveries, but you could envision, like we talked about before, this is the lease that I have now, right? This is blend and extend, right? Or so forth, whatever options you're looking at that you're working with on the tenant, you could have a scenario for each of those.
And questions about on the investment side, is there a rolling 12-month option on the investment?
I think there is, but I'd have to go back and look.
Let's just jump in and see if we go into the global values there.
Yeah. Investment tools. Okay, analysis.
Are we under settings?
Property global values, maybe.
Yeah.
I don't see anything.
So I think those are.
I think it's usually just rolling 12 months is pretty
It's
much.
from the point in time of the analysis.
Right. Yeah, I've always done it that way. There may be something buried in the program. I'd have to see if I can find it, but I think sort of the standard in the industry is to do things on a rolling 12-month basis.
Well, I think that covers us for today. Give it just another second, but I don't see other questions coming in. Looks like you covered the subject well. We will have more sessions coming forward on the lease analysis as the program continues to evolve and new tools are added to it. But this was a good preview, and I think a timely application for everyone as they're working with their tenants and landlords to try to help everyone manage through this and keep people in space and working rather than in default. So a lot of changes will need to take place to help everyone through this cycle. Jeff, thanks for joining us today. Everyone should have also received a note about the quarterly market update that'll be coming next Thursday at 4 o'clock Eastern. Hope you can join us. I don't know if you have a sneak preview of that, Jeff. I know you've got some insights based on the NACRE research, not to go into it, but maybe just a sneak of what you'll be focused on of some of the.
Yeah, we'll look at what we're seeing so far in the data from the different institutional investors that have to report their values and occupancy and rent and everything on a quarterly basis. No surprise that returns are down at 10-year lows. Categories that were hurt the most. What would you guess, Jeff, of the property types? what's
I'm
going to
pretty
be
sure
hurt the most?
hospitality was went to zero pretty
That's
fast.
number one. Yeah,
Yeah.
big negative return for hotels, and then retail, right?
Retail, of course. Yeah.
Retail, those both had negative returns. Returns for everything was down, but industrial still doing well. So industrial hurt the least. Um, and I did the webinar for the institutional investors, joined with the director of research at Hines, and also an appraiser that does a lot of the valuation work, owns an appraisal company that does a lot of the valuation of the funds, and he had some interesting examples of what was happening on some deals. So I'll mention some of those during the webinar.
Excellent. So we're looking forward to that. Look forward to everyone joining us. Thank you all for joining us today. And look like a couple last minute questions. Lease tool coming online this quarter. Yeah. So the lease tool, this new enhancement to the leasing tool, part of it, the first phase will be coming out either Friday or early next week. So look for it next week. We'll let you know that it's out and available. And then the lease accounting component, more likely it's a month down. So let's look at that for the end of June before that piece will be released. So it's all coming soon. Lots of work being done across the platform, but this is a primary focus right now to get this ready to roll for you ASAP. So with that, Jeff, Bobby, thank you. Thank you all for attending, and we will see you all next time. Have a great day.
You too.
Bye-bye.
Bye-bye.
Jeff.